Hello students, welcome to E-Pathshala. I am Dr. P. Shanti, Associate Professor, Department of Commerce, Avinashalingam Institute for Home Science and Higher Education for Women, Coimbatore. In today's class, the module selected is the Fundamental of Accounting. Under the topic, we are going to see about accounting concepts, conventions, rules for double entry system, journalizing, bookkeeping, subsidiary books, trial balance and preparation of financial accounts. The main purpose of accounting is to ascertain profit or loss during a specified period, to show the financial position of a business on a particular date and to have control over the firm's property. Such accounting records are required to be maintained to measure the income of the business and communicate the information so that it may be used by managers, owners and other parties. Let us learn the fundamentals of accounting in detail. At the end of this lesson, you will be able to analyze the various business transactions, rules for recording them and posting in ledger, ascertain and appreciate the financial result and financial position of a business. Coming to the meaning of accounting, before getting into the objective of accounting, the concept of accounting should be understood. Accounting is a discipline which records, classifies, summarizes and interprets the financial information about the activities of the concern so that intelligent decisions can be made about the concern. American Marketing Association defines accounting as the process of identifying, measuring and communicating economic information to permit informed judgments and decision by users of the information. Bookkeeping is a science and art of correctly recording in the books of accounts all business transactions that result in transfer of money. Bookkeeping is more a routine work and which is a part of accounting. The objectives of accounting are making decisions concerning the use of limited resources, including identification of crucial decision areas and determination of objectives and goals. Effectively directing and controlling organization, human and material resources, maintaining systematic records and reporting on custodianship of resources and facilitating special functions and control. With regard to basis of accounting, it is classified into three: cash basis of accounting. Under the cash basis of accounting, actual receipts and actual payments in cash are recorded. Under accrual basis of accounting, the income, whether received or not, but has been earned or accrued during the period, forms part of the total income of that period. Similarly, if the firm has taken the benefit of a particular service, but it has not paid within that period, the expense will relate to the period in which the service has been utilized and not to the period in which the payment for it is made. Under hybrid or mixed basis of accounting, both cash basis and accrual basis are followed. Incomes are recorded on cash basis, whereas expenses are taken on accrual basis. Accounting principles or guidelines to establish standards for sound accounting practices and procedures in reporting the financial status and periodic performance of a business. Accounting principles can be classified into two categories, namely accounting concepts and accounting conventions. The accounting concepts defines the assumptions on the basis of which financial statements of a business entity are prepared. The following are the widely accepted accounting concepts. The first one, entity concept. This concept says the business enterprise has separate identity apart from its owners. Therefore, whenever business received cash from the proprietor, cash account is debited as business received cash and capital account is credited. So, the concept of separate entity is applicable to all forms of business organization. Second one, money measurement concept. As per this concept, only those transactions which can be measured in terms of money are recorded. For example, health condition of a chairman of a company, working condition of a worker, sales policy, etc. do not find place in accounting because it is not measured in terms of money. Third one, cost concept. By this concept, the value of asset is to be determined on the basics of historical cost. Transactions are entered in the books of accounts at the amount actually involved. Many assets do not have acquisition cost. Human assets of an organization are examples. The cost concept fails to recognize such assets, although it is very important asset of any organization. Fourth one, going concern concept. According to this concept, the financial statements are normally prepared on the assumption that an enterprise is a going concern and will continue in operation for the unforeseeable future. Transactions are therefore recorded in such a manner that benefits likely to accrue in future from money spent. Fifth one, dual aspect concept. This concept is take care of double entry system of bookkeeping. Every transaction or event has two aspects. Sixth one, realization concept. It closely follows the cost concept. Any change in the value of asset is to be recorded only when the business realizes it, that is, either cash has been received or a legal obligation to pay has been assumed by the customer. Next one, accrual concept. Under this concept, the effect of transaction and other events are recognized on a mercantile basis. When they accrue and not as cash or cash equivalent is received or paid, and they are recorded. Accounting period concept. This is a concept of definite periodicity. As per going concern concept of an indefinite life of the entity, it is reasonable to divide the life of a business into accounting period. Matching concept. According to this concept, all expenses are matched with the revenue of that period should only be taken into consideration. Objective concept. As per this, all accounting must be based on objective evidence. In other words, the transactions recorded should be supported by verifiable document. Next, we will see accounting conventions. The term accounting conventions refers to the customs or traditions which are used as a guide in the preparation of accounting reports and statements. The important accounting conventions in use are convention of consistency. According to this convention, the accounting practices should remain unchanged from one period to another. An enterprise should change its accounting policy in any of the following circumstances only, that is, to bring the books of accounts in accordance with the issued accounting standard, to compliance with the provision of law, and when under changed circumstances it is felt that new method will reflect more true and fair picture in the financial statement. Convention of conservatism. This is the policy of playing safe game. It takes into consideration all prospective losses but leaves all prospective profits. The financial statements are usually drawn up on a conservative basis. The anticipated profits are ignored but anticipated losses are taken into account while drawing the statement. Convention of disclosure. Apart from statutory requirement, good accounting practice also demands that significant information should be disclosed in financial statements. Such disclosures can also be made through footnotes. Convention of materiality. According to this convention, the accountant should attach importance to material details and ignore insignificant details in the financial statements. Next, we will move on to the classification of accounts. The accounts are basically classified into three categories, namely personal accounts, real or property account, nominal or fictitious account. The system of accounting followed are single entry system and double entry system. Under single entry system, only personal accounts with or without subsidiary books are maintained, whereas under double entry system, it is a method of writing every transaction in two accounts. Rules of the double entry system. There are separate rules of double entry system in respect of personal, real and nominal account. The personal account means those accounts which records business dealings with the persons or firms. The real account contains the accounts relating to assets. Nominal account deals with expenses, incomes, profits and losses. The rules for double entry system is to record the accounts of personal nature, debit the receiver and credit the giver. Whereas in real account, debit what comes in, credit what goes out. For nominal account, debit all expenses and losses, credit all incomes and gains. Students, next we will see important aspect of accounting is accounting equation. Rules of debit and credit through accounting equations states that assets are equal to equities. The properties owned by the business are called assets and the rights to property are known as liabilities or equities of the business. Equities may be divided into equities of creditors representing debts of the business known as liabilities and equity of owners known as capital. Keeping in view the two types of equities, the equations can be written as assets are equal to liabilities plus capital. The equation given explains the basic accounting equation on which the double entry accounting is built up. Rules of recording equation. For recording assets, increase in assets are debits and decrease in assets or credits. Recording of liabilities, increase in liabilities or credits and decrease in liabilities or debits. For recording capital, increase in capital or credits, decrease in capital or debits. Recording of expense, increase in expenses or debits, decrease in expenses or credits. For recording incomes and profits, increase in income or profits or credits and decrease in income or profits or debits. As we have seen in the definition, which takes us into accounting cycle. It refers to a complete sequence of accounting procedure which is required to be repeated in the same order during such each accounting period. So, the accounting cycle includes recording, that is all transactions should be recorded in journal or subsidiary books as and when they take place. Next is classifying. All entries in the journal or subsidiary book should be posted to the appropriate ledger account. Finally, summarizing. The last stage is to prepare trial balance and final accounts with a view to ascertain profit or loss made during the trading period and the financial position of the business on a particular date. The business transactions are recorded initially either in journal or subsidiary books. Journal is derived from a French word jour, which means a day. Journals therefore means a daily record of business transactions. Journalizing means recording a transaction in the journal and the form in which it is recorded is known as journal entry. The format shows the particulars to be entered in the journal. So, the first column deals with a date wherein month, date and year of occurrence is to be recorded. Particulars, in particulars it is to be written, the account to be debited is written first, followed by the account to be credited, and the entire details of the transaction is given as a narration. And LF stands for ledger folio, that is the page in the ledger in which the particular transaction is to be posted. The debit and credit amount column shows the amount worth of which the transaction took place. The example shows the journalizing of the transactions. There are few transactions which is given and the entry shown below shows that suppose on 2016 January 4th there was a cash purchase of 29,000 and on 6th there was a purchase from Mr. P for rupees 40,000. On 7th some goods were sold to Mr. B for 16,000 and on 18th Mr. B become insolvent, so 8,000 rupees is realized from him. It has been typically shown in the journal, that is for the first entry purchases made, the two transactions involved are purchases and cash account. So, debit purchases account and the credit is given to cash account with the amount of 29,000 and the narration says for purchase of goods for cash. The next, for the goods purchased from Mr. P, the purchase account and Mr. P's account is involved because it is a credit purchase. So the party name should appear. So purchase account debited with 40,000 and Mr. P's account with 40,000 for credit purchase of goods from Mr. P being the supplier. Next, for the credit sales made to Mr. B, the entry is Mr. B's account data to sales account rupees 16,000. This narration is that for being credit sale of goods to Mr. B. Whereas on the date 18th, it has been given that only part of the amount is realized from Mr. B as he become insolvent. So the entry to be passed is cash account data with the amount realized rupees 8,000. So amount which is not to be realized as he is an insolvent to be transferred to bad debts account with 8,000. So total amount to be collected from B is representing 16,000. For this, narration is for cash received from Mr. B on his insolvency and the amount written off as bad debt. Next, other type of book is a subsidiary book. Subsidiary book comprises of the following, that is, purchases book are maintained to record credit purchase of goods, sales books to record credit sale of goods, purchase returns book to record returns to supplier, sales returns book to record returns from customers, cash book to record all cash receipts and payments, bills receivable book to record bills received, bills payable book to record bills payable accepted, followed by general journal or journal proper to record any other transactions which cannot be entered in the above specialized subsidiary books. In the accounting cycle, the next stage is posting to ledger. A ledger account may be defined as a summary statement of all the transactions relating to a person, asset, expense or income which have taken place during a given period of time and shows their net effect. Ledger posting of journals. Every transaction is first recorded in the journal in the form of a journal entry. The process of transferring the transaction from journal to the ledger is known as posting. The following example will make it clear the process of posting. On 4th April 2016, there was goods sold for cash rupees 2,500. It is given in the form of journal entry as cash account data to sales account 2,500. The journal entry given is to be posted in two accounts, namely cash account and sales account. The format of the journal is given as with the details, date, particulars. JF means journal folio and the amount. So the left hand side is representing the debit aspect of account and the similar columns on the right hand side shows the credit aspect of the account. So cash account is debited and to sales account is recorded with 2,500. Next, in sales account it will be written as by cash account 2,500 on the same date. Next, we will see about the trial balance. The fundamental principles of double entry system of accounting is that for every debit there must be a corresponding credit. Therefore, that the sum total of the debit amount should be equal to the credit amount of the ledger at any date. Thus, at the end of the financial year or at any other time, the balances of all the ledger accounts are extracted and written up in a statement known as trial balance. The agreement of the trial balance reveals that both the aspects of each transactions have been recorded and that the books are arithmetically accurate. If the trial balance does not agree, it shows that there are some errors which must be deducted and rectified if the correct final accounts are to be prepared. The format of the trial balance is given. The trial balance can be prepared on any date. So it is given trial balance asset, and the first column name of the account, the ledger folio, that is the total arrived on which page of the account, which page of the respective account, and the debit or credit balance to be recorded. Ultimately, the debit balance should tally with the credit balance. Final accounts. The final accounts are prepared to achieve the objectives of accountancy. In order to know the profit or loss earned by the firm, income statement or trading and profit and loss account is prepared. Balance sheet or position statement will portray the financial condition of a firm on a particular date. Final accounts include the preparation of first one, trading profit and loss account or revenue account, and the second important is the balance sheet. The trading account, this account is prepared to know the trading result of a business, that is how much gross profit the business has earned from buying and selling during a particular period. On the left hand side, or that means the debit side, will record the opening stock and all the direct expenses relating to business. On the credit side, sales and sales returns and closing stocks are recorded, and ultimately this account will reveal gross profit or gross loss of a concern during a particular accounting period. Next, profit and loss account. This account is prepared to calculate net profit of the business. There are certain items of income and expense of the business which must be taken into consideration for calculating the net profit of the business. A pro forma of the profit and loss account is given. The profit and loss account will again represents for a 1 year period. The first item recorded shows that which is a balance transferred from a trading account. It may be either a gross profit or gross loss. The debit side of the profit and loss account will represent all indirect expenses. The credit side of the profit and loss account will represent gross profit and the income earned from other dealings. On closing this account, ultimately it will reveal net profit or net loss of the business transactions carried out for 1 year period. The next important statement is the balance sheet. A balance sheet is a statement prepared with a view to measure the financial position of a business on a certain fixed date. A properly drawn up balance sheet gives information relating to the nature and value of assets, the nature and extent of liabilities, whether the firm is solvent and whether the firm is over trading. A pro forma of the balance sheet is given. The liability side will bring about fixed liability, long-term liabilities and current liabilities. In the asset side, it is prepared to record fixed assets, intangible assets, floating assets and current assets. Limitations of accounting. There are few limitations of accounting. It records only monetary transactions. Effect of price level changes are not considered. No realistic information. Personal judgment of accountants affects the accounting statements. Permits alternative treatments. No real test of managerial performance, and the records are historical in nature. Let me summarize this session by saying that the objective of management is to manage the business in a systematic way with the plans and allocating resources, responsibilities and properly utilization of resources. The accounting, particularly the financial accounting, helps in a huge way in proper planning the activities, making decisions and controlling business operations by providing the required information to the management in such a form it will be helpful to the management. Not only this, the accounting practices followed, since it is based on certain principles, it can be adopted on single country transactions and multi-country transactions. There are certain standards which are established at the country level and at the international level, so that disclosure of information is possible and understanding of accounting is also possible from the people around the world. So, accounting is found to be very systematic and prudent way of recording, providing reliable information, thereby helping the management to the objective use of its resources. Thank you.